invest in moats. Well, that's been the golden rule of investors like forever, right? Now, Peter Thiel wasn't beating around the bush when he said competition is for losers. What's his point? Real lasting money comes from businesses that play monopoly like the pros. You even had Warren, who keeps it even more simpler. He says that the most important sign of a great business, pricing power. So, agar a company can keep bumping up their prices and as customers still run to them and purchase their product or solution, you've got a winner. Here's a slight twist, especially in India. Our policies, they tend to cheer competition. Our former RBI governor Raghuram Rajan once told the Competition Commission, and I quote, "Competition is the life force of a modern economy," end quote. And the government's job, it's not to hand out monopolies, but to really make sure that no one is getting too powerful. Welcome to Bottom Line by Grow. Today, we are zooming in on the Indian scene like we always do. You see, when you buy a monopoly here, the question is, are you really getting like solid pricing power or just like a permission parchi from the sarkar that can be taken away anytime? So let's watch how these moats work, how they stay strong, how they sometimes flood when the rules completely change. So first off, let's understand how monopolies even pop up in our country. Spoiler alert, they're often handed out. They're not fought for in a competition. So step one, you have state concessions and licenses. Take IRCTC. They're not just big, it's the only player allowed by railways to sell online reserved tickets. And man, that's a real monopoly. In FY25, they made 1,426 crores just from internet ticketing. And every day, you have almost 13.9 lakh tickets that are getting booked online. And that's 86% of all reserved tickets. And what's the secret sauce? It's a small convenience fee. It's 15 rupees for non-AC plus GST and 30 rupees plus GST for AC tickets, and that brings in 74% of their profits. So the monopoly magic here is the convenience fee. Next, you have some monopolies that are not just a privilege, they're written into the law. Coal India, they're not just big, they're a parliamentary monopoly. And since 1973, that is for over 50 years, they've been the sole commercial miner of coal. And even with the recent reforms, Coal India did 75% of the total mining in FY25. And plus, you also add to all of this, 90% of the coal goes through government deals that's keeping their demand fully locked in. Let's now dive into one other moat type, which is platform or network effects. Now, I want you to think of platforms as parties where every new guest coming in is making the party better. So more buyers bring in more sellers, and more sellers bring in more buyers, and suddenly you have one or two players dominating the entire dance floor. Let's talk about IEX, Indian Energy Exchange. They kind of ruled the electricity spot markets because they had liquidity and the Janta kept coming back for more. In FY25, IEX had 85% market share and they brought in over 650 crores while their nearest rival barely made a dent. Similarly, you take that model and you put it into equities and you get NSE, National Stock Exchange. Now, their near monopoly in equity derivatives, that comes from deep liquidity and tons of market players. So when you had BSE, the Bombay Stock Exchange, that tried to chip away by slashing fees a few years back in 2023-24, they grabbed 17% market share from NSE's nose in under a year. Now, this shows that network effects are strong, but they're not invincible. And even behind the scenes, you have network effects that really matter. Take CAMPS, who manage a mutual fund data. They handle 68% of the entire industry's assets. Now, this huge volume creates trust and lock-in. They make it the go-to registrar. Now, this is not a law monopoly, but just sheer size and integration. So far, we have seen how moats form, but the same rules can also tear them down really quick. Here are 5 ways these so-called monopolies have been, punched in the gut. The first way, regulatory enforcement and discretion. Now, if your whole dhanda is riding on one government license, one rule can shut you down. Rewind to October 2021. Railways told IRCTC to share half their convenience fee. Now, IRCTC's share price went down 30% even though their order book flipped back pretty fast. And that moment showed investors how fragile monopolies can be. One rule, one shock. Now, even now, and we are talking in September 2025, IRCTC isn't back at its all-time high. It's stuck lower because there's that regulatory fear that is still around. Channel 2, you've got policy and market design shocks. Now, regulators, they can flip the market script and wipe out an advantage entirely overnight. Now, IEX, they controlled 99% of the spot trades thanks to their liquidity. But in July this year, in 2025, a new market coupling rule merged all the exchange orders into one pot with a uniform price. And boom, the source of IEX's power got centralized. On July 24th, 25th, the stock crashed 30%, hitting a 52-week low. Now, rivals get to compete on a level playing field, and it's slicing away IEX's dominance. Market merged, the moat is splashed. Channel 3, you have concession and contract risks. So, when your entire business is depending on a long government contract, missing a tender can tank you. So your Protean eGov, they started sweating when they didn't get shortlisted for the big PAN 2.0 overhaul. Their stock down 30% in 2 days. And now you're really talking pressure. Half their revenue came from tax services. So losing that was a real hit for Protean. Your concessions can also cut both ways. In August this year, in 2025, Protean also snagged a 1,160 crore Aadhaar project win, and the stock bounced back 11%. One win, one drop, the tender game rules the multiple. Channel 4, you've got network loss and an ecosystem collapse. Now, platforms live and die by partners, but when those key contracts go direct, the platform's network starts thinning and your moat starts crumbling. Take Dreamfolks. Now, they were big. They were huge in airport lounge access and they controlled 90% of the market. But then Adani Airports, they decided to bring in a new partner. They rolled it out and they had their own lounge network and they pulled out. And other big partners followed. And boom, Dreamfolks stopped all domestic lounge services in September 2025 and shares tanked 76% in a year. Partner gone, moat, tata bye-bye. Channel 5. Fiscal and judicial bans. Sudden tax hikes or court orders can make your whole business lines vanish. Take Delta Corp. They're known for running casinos and they're in the gaming business. In September 2025 this year, GST surged from 28% to 40%, and this hit stocks hard. They even paused a big 2,000 crore resort project. Talk about a real growth break here. And with shrinking profits, the stock is now trading roughly 80% to its 2018 peak. On the gaming front, this is still fresh off the news. You know what happened with Nazara. They got a real shocker in August when a new law banned online RMGs, real money games. Their stock down 23% as their Pokerbazi stake faced full uncertainty. The app survived. The landscape changed overnight. One day you're in the rainy Nilgiris forest and next day you're in the Thar desert. What's the bottom line? In India, many moats aren't really fortresses. They're permissions. They're a license. They're a network. They're like a regulator's thumbs up. You have one tweak and you have IRCTC's cash cow that got fully shaky. You had one policy change and IEX's liquidity castle starts crumbling. You have one lost tender and Protean story has a full shift. You have one tax hike and Delta starts hitting the pause button. You have one vertical integration and Dreamfolks unplugged from its monopoly. So before asking what's the moat, you should be asking 3 other questions. Who's handing out the permit? Who can yank it back? And when could they yank it back? Thanks for watching. Keep the conversations alive and we'll see you back soon.